Everyday finance channels on YouTube put out videos talking about investing in dividend stocks. There is a never-ending amount of content about the best dividend stocks, how you can become a billionaire of dividends, or how dividend investing is an amazing passive income strategy. Many of these YouTubers invest in stocks just because they pay a high dividend. In fact, there are many professionals that advocate dividend investing. There are countless funds and ETFs that only invest in dividend stocks, and there is a growing number of regular investors who do the same. They just invest in stocks because those stocks pay them a dividend, because some schmuck on YouTube told them that dividends will make them insanely rich. One of the biggest investing mistakes that I see investors make over and over is believing all of this and buying a stock just because it has a high dividend yield. So let's break down why dividend investing is a bad strategy. And I know that this will irk people because dividend investing has grown into some kind of weird cult, and some of the cult members will be down in the comments section writing, "Sasha, you are so dumb. Dividend investing is free passive income." But if you actually want to understand why dividend investing is a bad strategy, I am going to explain in some detail using things that hardcore dividend stock investors are unfortunately allergic to, like, numbers and data. First, let's talk about the fundamentals of what a dividend is. A dividend is the distribution of a company's retained profits to its shareholders. And it sounds great, right? Every quarter you get paid by the company that you are invested in. Sounds like amazing passive income, except it isn't income, and you're not making any money. I know, it's sad when facts go and smack you right in the face. To understand this, we need to talk about how companies are valued. A company's valuation, which by the way is what share prices are based on, is the sum of two components. The first component is the sum of all future cash flows of the company discounted to the present value. So you forecast how you think a company will perform in the future, how much money they're going to make, and then you add it all up, applying a discount rate to understand what the present value of those cash flows is. But then you have to subtract something from that number. You have to subtract the company's net debt to get to the final valuation. And the company's net debt figure is the sum of all of its liabilities, things like debt, long-term debt, etc., minus its cash equivalents, and marketable securities. So to put it simply, the cash that sits on a company's balance sheet is part of the total value of the company. Every dollar that the company has on the balance sheet equates to $1 in the company value. When you buy a share in a company, you become a part owner of that pile of cash that the company has in the bank account. And when the company goes and pays out a dividend, the dividend comes straight out of that very bank account. So you receive your dividend, but the company also loses cash in the process from that very bank account. So the value of the company drops by the exact same amount that you receive. So the unfortunate truth is that after you receive a dividend, you have exactly the same amount of value as you did before the dividend was paid. Not more, the same. It's just that after the dividend is paid, the value of your investment is a bit lower and you have a little bit of cash in hand instead. But the total value of the amount that you have invested and that cash is the same as it was before. I know it will be surprising to some people that in fact dividends do not grow on magic money trees, and this effect is difficult to see because dividends are relatively small and the drop in company value as a result of paying dividends will typically get lost in the noise of day-to-day stock market fluctuations. The effect of receiving a dividend is equivalent to selling a small part of your investment. If the company didn't pay the dividend and you sold the same exact proportion of the stock that you own, you would be in exactly the same position. You would own a little bit less of the stock and have a bit of cash from the stuff that you've sold. But you can choose when or even if you want to sell a stock. You don't get to choose with dividends because the company pays them out every quarter as and when they want to, regardless of whether you want them or not. Now, it gets a lot worse. First up, each time you receive a dividend, it is a taxable event. You are earning money and unfortunately you have to pay money back to the taxman. Depending on the country that you live in, and dividend tax can often be between 20 and 40%. So for every dollar in dividends that you receive, you will have to go and give up 20 to 40 cents, leaving you with, say, 60 cents. If you go and reinvest that 60 cents back in the company, because, compounding dividends is the magic formula for becoming impossibly rich, of course, you are left with less value after the dividend got paid out than you had before. Just let that sink in. Now, this may not be an issue, and I'm sure some people will point this out in the comments, if you are only investing smaller amounts of money and live in a country like the US or UK where you can get an IRA or an ISA account where you don't have to pay dividend taxes if you reinvest them within the IRA. If you want to withdraw the dividends because, passive income bro though, or if you want to invest larger amounts, tax will very quickly become an issue. And the tax issue compounds in a very bad way. So let's assume that a middle of the road dividend tax is 20%. It'll be different depending on where you live, your specific circumstances, the tax code of the country you live in. It doesn't really matter. It's not massively important for the example. When you receive a dividend, because of the 20% tax rate, you will only get 80% of the dividend after tax. And you decide to go and reinvest that money back into the dividend stock. Then, when that investment, that money you just put in earns dividends on the investment that you bought with it, those dividends will also be taxed at 20%. So the 80% that you put back in loses another 20%. And the dividends that you receive are now worth only 64% of the original value of the investment that got paid out to you as the very first dividend. If you then go and reinvest that dividend again to buy even more stock, you lose another 20%, and now you're only making back 51% of the original value that you had. You can see the problem here. This constant cycling of money over a long period of time through something where you have to pay tax every single time you cycle becomes significantly more expensive than paying capital gains tax and massively restricts the compounding effect that you can have with your investment portfolio. And if you want dividends to be a significant part of your income, you will have to invest a lot more than the amount that you can put into these tax-free account wrappers. So unfortunately, they won't help you much. But here is where it gets even worse. If a company is paying you a dividend, it means that the company that you are invested in doesn't think they have any way to put that money to better use. So you're investing in a company that has no way of actually making more money from the money that they're paying out to you. It means the company doesn't think that they can take the dollar they're giving you, put it to work, and make it worth more than $1. The question then becomes, why are you investing in that kind of company? Theoretically, it should be the last resort for a company to go and pay out dividends when they have no other use for the cash, because pretty much every other way to deploy, to use that capital is more effective. First, the dividends can be used to pay down the company's debt. Debt held by companies is taking away from the value of your investment. Every dollar spent on repaying the debt gives you as an investor $1 of extra value in the investment with no need to pay a big tax in the process. And not only that, but the debt also costs money in fees and interest. So when a company goes and pays down the debt, they have to throw away less money every quarter on paying that interest. So in fact, every dollar that the company uses to pay down the debt becomes worth more than $1 through improved future cash flows. And it is astonishing how many companies out there are paying extortionate dividends while carrying ridiculous amounts of debt. Walgreens is a very popular dividend stock, and you can see here on Simply Wall Street that they have $13.5 billion worth of debt. Most of that debt is long-term debt, and that long-term debt is growing while they are paying dividends. That debt is costing the company money in interest payments every single month, and it's bad for the balance sheet. But you can see that Walgreens pays a 5.4% dividend yield. I will leave a link to this Walgreens data in the description below, and you can even sign up for a free account with Simply Wall Street if you use my link. And if you use my link, you will get 2 weeks free of the unlimited plan, so please feel free to go and check it out. An amazing graphical resource for doing company analysis. So, dividend Dividend investors are happy because they think that this dividend is some kind of magic passive income. But the reality is that the company is quite literally, in many cases, borrowing money and paying interest on it, and then using that money to pay you a dividend. It's a bit like taking out a credit card, taking the credit card to a cash machine, withdrawing $100, and then thinking you just made a free $100. But there are a million other ways that a company can also deploy cash other than repaying debt that are also far more effective than dividends. The company can reinvest back in the business. You can put it into the capital expenditures, build more factories, get more shops, invest in new technology, whatever it is that you need to grow and develop your business. You can deploy it into research and development, hire more staff, improve your products. You can increase the marketing spend to grow your business through selling more. You can make acquisitions of other businesses, tactically buy other companies that complement your business, that maybe open up new opportunities. If you are paying a dividend, then presumably you don't think there is anything at all that you can do with that money in any of those avenues to grow your business. So instead, you might as well just pay it out. And this is very often a sign of stagnation or a company being in decline. Because if a company has growth prospects, serious growth prospects, they will often need capital to grow their investment. They will usually have far better ways to deploy the cash than paying out dividends. And you can see that in the last 5 years, Walgreens' share price has been on a steady decline, losing about 56% of its value. Again, you can go and check that in the link below on Simply Wall Street. So yeah, you can go and earn 5% a year in dividends, which is free passive income, bro. But you can also get to lose 56% in the value of your investment while you're doing that. This is a story that is all too common. People go and invest in these dividend stocks. You get all happy when you see these regular payments turn up, and it makes people feel good because they see literal cash turning up in their account every single month or quarter or whatever, and then realize 5 years down the line that they actually lost far more in the drop in share price than they ever got in dividends. But wait, I haven't finished. Sometimes a company just doesn't have better ways of deploying cash. That also happens. Sometimes they just max their business model. Maybe they have a very particular kind of product or service. They have sold it everywhere that will ever buy it. They don't want to take the risk of expanding into new spaces, and they've repaid all of their debt. Everything is dandy. Even then, dividends are not the best option. The company can instead, for example, go and repurchase its own stock through buybacks. The net benefit to you as an investor is exactly the same. The company deploys the capital to reduce the number of shares outstanding by buying their own stock. And you end up owning a bigger proportion of the company. So your shares are worth more. And this doesn't cost you 20% or 40% or whatever in tax, and doesn't force you to have time out of the market between whenever you receive the physical dividend in your brokerage account and happen to remember to reinvest it. And here is the funny bit. Even if the company does nothing with the money, it's still better than paying a dividend. This is mind-boggling, but unfortunately it's true. If a company just keeps the cash on the balance sheet, doesn't do anything at all with it, it's still better for you as an investor. First up, there is no taxable event being triggered, and you still get to own that cash through the shares that you hold in the business. Second, the company might not have a good use for the cash today, but they may come across a new opportunity, a new avenue. Something happens in 3 years that will suddenly require a lot of capital, and they will have the capital. They won't need to go and raise a colossal amount of debt. And cash on the balance sheet means that the company is better prepared for weathering economic downturns and financial turmoil. The company can survive a major recession or go through a depression, and their credit rating will improve because of the healthier balance sheet, and that makes it easier and cheaper to borrow money if they need to, and can reduce the costs on the money that they have borrowed to date. If you look at the S&P 500 over the long term, a very small fraction of the total amount of growth and value comes from dividends. And that's because growth comes from reinvesting money, not going and giving all that money away to the shareholders. And if you invest in companies with abnormally high dividend yields, 5, 6, 8, 9% or more, it is very likely that you are either investing in a dying company in a dying industry, because, oil companies and tobacco companies tend to pay very high dividend yields, and there might just be a reason why, or you're investing in a dividend trap. I remember last year, every one of these dividend investing channels were drooling all over investing in AT&T, because AT&T is a great, stable, stable company, they pay a robust dividend, it is absolutely guaranteed, you can retire early, blah blah blah. And sure enough, AT&T went and halved their dividend payments last quarter. And the investors are sat there holding their private parts and their bags where they invested in the company only for those dividends that are no longer there. Now, the point isn't that you should never invest in a company that pays dividends. The dividends themselves are not really relevant. Plenty of companies out there pay some kind of a dividend. Just don't base your investing decision just on a dividend. In fact, it is a good idea to just ignore the dividends and treat them as a bonus perk in addition to the core investing decision that you are making, because presumably the majority of your long-term investing gains are going to come from non-dividend sources of growth. If you found this video useful, please don't forget to smash the like button for the YouTube algorithm. Thank you so much for watching. I really appreciate it. And as always, I'll see you guys later.